We better start because we've got limited time. How are we this morning?
Freaking awesome. Really good.
Friggin' awesome. Nice. Ash, Jack?
Yeah, good. No complaints.
You are looking very colourful, Ash.
I'm wearing white and blue.
Oh, it's okay. Just seems colourful considering what the rest of our uniforms normally are.
I've got black and grey.
Yeah, I've actually got my uniform on today. Done.
Oh, you got canopy.
Nigel, if you're listening, I need a new jumper.
Yeah. No, we need to. He's going to be finalising a raise at some point. We'll make that contingent, Jack.
As we're going to talk about later, as Rayn says, you're doing it right, Jack. You're investing the right way with the swag.
Yeah, that's exactly right. What have we been up to? It feels like this week has just disappeared.
I've had my head in a laptop for, what is it now, 4 days straight. So I don't even know what day it is. Other than the fact I know it's Thursday because it's podcast day.
Yeah. And we're going to the US in 2 days, Aaron. Is everything organised?
Next question. No, everything has come together well. I'm excited. The only little bit that's making me nervous right now is the weather in New York. Like seeing the images and photos, like there is significant snow and ice in the streets.
Isn't it something like 600,000 people in that region are currently isolated?
Yep. And transport systems in chaos, apparently. People not able to make it into the office. And we're taking a group of 15 there for back-to-back meetings.
I'm only taking my canopy hoodie.
Oh, the most hilarious combo was yesterday between Jack and Ash. And Jack said, should I take a jacket? And Ash was giving Jack a bit of a touch-up of, mate, it is bloody below zero.
It is chilly. I really enjoyed our go-to-market workshop yesterday that we hosted on Zoom. I think there was almost 50 people there, wasn't there?
Yeah, we had 50 registered and really good engagement from the group. I came off that energized. I love the work we do with founders. That was a lot of fun.
Yeah. And sometimes, even though some of the things can be a little bit basic, it's good to just take time out of your business to go back and remind yourself. And Jack brought in the cavalry, reminding people of why accountability and metrics were required. And I think a lot of people got a lot out of that.
Yeah, it touches on my theme of the week for later. It's simple but difficult. Like this stuff is simple, but it's the doing of it and finding the time outside of the business to actually do this stuff.
Simple but difficult is just a personality profile, isn't it?
Yeah. My kids had a conversation about what is fun but painful, and they referenced me. I'm like, okay, that's we need to talk about this.
Just wait till they get older. Why don't we kick in, because we've got a good little schedule here. It came out yesterday that the SafetyCulture CEO that was appointed, Kelly Voos, that was appointed last year, is going to step down on the 31st of March after concluding that leading a major platform rebuild on the back of the AI revolution from New York was not workable. Kelly had spent a decade of leadership Kelly has a decade of leadership experience at Blackstone portfolio companies, this AFR article said, and a decade of using SafetyCulture platform as a customer. And at the time, it was believed those credentials made him an attractive fit when Luke decided to transition to the executive chairman role. Kelly, who has teenage children and family commitments to the US, was never expected to relocate to Australia. And as the scale of the rebuild became clear, this article said he was the one who raised the problem. In another article from Bronwyn Clune of Capital Brief, it says Luke Annear had said that Kelly had quit because it became too hard for him to commute from New York. He basically said that all of our products are in Australia, so it needs to be helmed from here. Although Luke said that Kelly's departure had nothing to do with the global reckoning, which has decimated software companies in public markets, when Anthropic released its large language model that can code from scratch. If you don't mind, can I just play a little bit of something from a prior episode?
I'm surprised it's taken this long into the podcast. We'd play it.
I've been working with a Buddhist on becoming more humble. I'm going to make a little prediction. This external CEO that was appointed by Luke last year, I think he'll be gone in 2026. Their losses expanding, and it talks about new executives that have come from companies that have come from Microsoft and all sorts of other larger companies. One of the oldest patterns that we talk about all the time on this podcast is when the founder moves to executive chairman role, so still has a role in the business, and it appoints an external CEO. Founders build companies that are well-tailored suits to them, how they like to operate, how they like to behave. And then you hire someone external and you try and you say, okay, you're CEO now, I'm going to hand this off. But the founders built a well-tailored suit to them and the new person often doesn't fit. So there's this whole period of time of bringing in new people. So a new guard forms whilst there's still an old guard. The old guard still has a direct relationship with the founder. And what happens behind the scenes is people go around the new CEO when they don't like something. And to begin with, founders tend to go, oh no, I've got to back this person. But after a while, when results aren't quite where we're at and we're not moving at a speed that I bet you would be desired inside of that organization, little things start to chip away, then conflict starts to occur, and then that ends up leaving. So I'm just going to put a little stake in the ground. And then when the reports of it coming, it's never the background story. There's always family reasons or personal reasons or a new opportunity. We really want to thank them for their service to the company, but actually behind the scenes, it's a repetitive process. And then what will happen is either Luke will step back in for a period of time and then they'll go and do the same thing again. Or if he's got all sorts of other bits and pieces going on, a new CEO will be appointed and then the same thing happens. Have a look at, money doesn't solve these things. It's process that solves them. Have a look at Andrew Forrest with the revolving doors that Twiggy has with executives. Even being Australia's richest man with all the money in the world doesn't solve this. It's actually a process thing that the company has to evolve. And that's one of the things I pride our work with founders on, is that I think we do a pretty good job there.
Except you called it.
Yeah. In this instance, none of the articles have Luke thanking him for his service. So that tells me that things really got quite bad, because there's no even acknowledgement of the work that normally goes, because there's normally platitudes to make it all better. It was just, the cycle repeats.
The cycle repeats. There was one little platitude in there saying that it was the new CEO had actually raised this issue. But
that's
I'm just saying that was the only little thing. But John, do you want to speak to the place that you were able to make that prediction from? Because these patterns play out and you've seen them across the life cycle. But just to help, I guess, investors and founders that are listening, how do you know these patterns and how were you able to predict that? Because you pick this stuff so often and you get it right.
Eucalyptus's corporate life cycles, there's a reason why he's got something like 30 honorary doctorates from different universities around the globe. It's all laid out in a book and it follows these things to a T. A lot of founders repel because they hate the idea that they could be a cliche pattern. They hate that they could possibly not be special and special circumstances and all of that. And that's why one of the reasons I probably left the consulting world, because it's just too difficult. But these patterns play out in a life cycle. And I've been doing this for 20 years almost. When you've got a model and a framework that to date hasn't been beaten, and then you see certain little ingredients that by themselves, the general view doesn't have a model to put all those ingredients together. So I'm not actually all that bright or clever. I'm just very good at finding patterns and frameworks and then finding the information that helps work out where you are in that pattern and framework. And so we've spoken about it multiple times and I keep recommending it. Corporate Life Cycles by Eucalyptus just lays exactly everything out. The only difference with AI in the world that we're in now is that life cycle speed between the phases is accelerating. And so companies can be born, grow, age, and die much faster than has ever happened before. And so you've actually got to be looking out for the issues with a lot more detail. And then the same time is that really what you're talking about in a life cycle is you're traversing through different phases of change. And with change accelerating, what does change create? Well, it creates problems you got to deal with, and you got some opportunities you got to deal with. But because we need people involved in that, and people have different styles, perspectives, roles, values, interests, what happens is you end up with this complicated soup that the more the world changes, the more the problems you've got, and the more that conflict can come to the surface of all of those different ingredients. And that's where we concentrate from a portfolio support point of view, not really telling them what to do. They're founders. If they don't know what to do, then we're all fucked. But how to go about it, sometimes that's where we try and put some rails to run on.
I think it's a good thing Luke's back. And I was going to ask what your next prediction is, but it's actually, you've already said it in there, like Luke coming back and then the cycle repeating.
Oh, it's what's needed. Like, you need some founder, benevolent dictatorship, high energy drive to go and break down the old and bring in a new, and only that kind of high vision, high passion that's willing to break a few eggs along the way is going to get this job done. This is not the time to be trying to systemize and corporatize and create all the transitionary things so you become this sort of machine, because none of that matters if you don't survive. So you need a hardcore founder that's going to break some eggs to get it back in. Now, the question will be, have any lessons been learned from the appointment of an external CEO that they will bring at the next appointment of a CEO, or will it be like so many other organizations? Will the revolving door of CEOs continue? But, that's up to them.
I think it's great to see, hopefully, Luke come back in. I think it's needed. It's a trend you're seeing across other businesses like Intercom in the US as well. Like, it's a massive business, and it's consistent where, CEOs are saying it's time to, roll up our sleeves again with this big shift in AI. It requires that true founder mentality to really drive the next iteration of the business. So I think seems like the right call, and keen to see how it unfolds.
Yeah, nothing from me, Don.
There's got to be something, Jack. If there was something, what would it be?
No, nothing. I think you picked it. You were bang on.
Those are the only words I need, Jack. Another founder that has stepped down from the CEO role to become executive chair is one of the co-founders of CultureAmp, Didier Elzinga. And there was an article in Capital Brief, and it's by Bronwyn Clune, that says technology stocks have been hammered in the global software sell-off, dubbed the SaaS apocalypse, and Australia's most celebrated software unicorns are far from immune. Street Talk understands the CultureAmp. This wasn't in Capital Brief. This was in AFR. I'm sorry. Street Talk understands the CultureAmp, the people management software company backed by Blackbird, Hostplus, and the two billionaire co-founders of Atlassian, tested buyer appetite for a potential liquidity event or change of control last year. Options included bringing on a new minority or major shareholder. At the time, it met with large private equity firms, while bankers talked up strategic interest from offshore industry players. However, potential investors balked at CultureAmp's valuation expectations on the basis that the business, while growing revenue, which is now at 177 million US or 250,000 Aussie, remains deeply unprofitable. CultureAmp's narrowed its losses to 24.2 million for the 12 months June 30, 2025, from 35 million US a year prior. So that, how much has the world changed that they can't pull off something like this? And again, coming back to the safety culture conversation we have, some of the conflicts that are likely going in there, because when you've got desires from shareholders for liquidity, desires from staff for liquidity, valuation under pressure, staff worrying about the value of their shares, is there actually any value? If you think of an entity with a certain amount of energy, if a big percentage of energy is going on to this stuff, there's just far less energy to go to changing the company, to improving the company. And what tends to happen is the culture starts to feed into its performance and things only get worse.
Don, what is your view on the founder stepping down out of the CEO role and onto a board or chair? Like, I've got to be a bit cagey, but a board meeting I was kind of across this week was exactly this. A founder of an engineering firm had stepped out, become the chair, put an MD in place. That MD has come to the board with all these recommendations, which are basically ways of saying, here's all the problems that exist in the company. And the chair became the blocker, essentially, because it was an insult to what they had left and their legacy. And so these patterns, often subconscious, but almost seem inevitable. Can it ever work, I guess, is the question, because I see so many times it doesn't work.
No, it can, as long as the step before the appointments was actually starting to change the managerial process to go from centralized to some level of decentralized around problem identification, problem prioritization, planning, implementation, execution, and accountability. And so where it sort of works is that there are enough people on the board or influencing the founder to understand that the transition is not the appointment of a person. The transition is process orientated, and then an appointment of the person, because then you've started to practice some of those things that founders find very painful. If there has been no transition of managerial process and restructuring, and the analogy that I used last time is that well-tailored suit, and that comes from Ishak. It's a well-tailored suit, perfectly designed for you, and then you try and put it on someone else. It doesn't fit. It's constricting. And what do they want to do? They want to sort of change it, and that's really difficult for the founder. So if that work hasn't been done in the best interest of the business, if the company has sustainable cash flows, if the company has got a reasonable amount of runway, the best thing the founder can do, just like a parent at a certain point, the best thing a parent can do is get the fuck out of the way of the child and let the child live. Founders find that very difficult, which is why when things get really bad, if they've lost control, they get ejected by the board. Now, that is not ideal, because then you lose the founder's energy. You lose the founder's passion. You lose the insights that only founders can get. But losing that is actually better than the dysfunction of the fights that occur. So it's not an ideal situation. But the best situation is when a decision is made, a transition is going to happen, you bring in an approach that can start to retailer the suit. You start to get the organization moving in that direction. The founder's able to start handing off more and more roles until finally they can move just to chair. My suggestion is never executive chair. Like, it's just the conflict of interest and looking at your baby and looking at things that you wouldn't do. If you want to be on the board and be able to provide those insights, great. And if you want to be in strategy and key decision-making meetings, I think that's wonderful as well, as long as there is systems and process to handle that energy. Otherwise, it just becomes anarchy.
Do you guys have any insights into how Technology One have done it? Because we know that Adrian's definitely taken the back step now, and by all reports in the media, they've got the CEO that they've grown internally that is only going up and to the right.
Yeah, he grew it internally over many, many years. When you actually have a look at the history of what Adrian did, he didn't just abdicate. He didn't just go, right, here you are. That role started to emerge out of multiple candidates. Then somebody started to float to the top. Then they started to take more responsibility. Then they started to take different functions, and they sort of worked and they brought in those systems, processes and controls. It took quite a while, but we know Adrian's a very systemic mind. When he looks at an issue, when he looks at a company's performance, is it people, process, systems or strategy? Like he already has that inbuilt, which is why he was able to build a global ERP company. And the best way is from internally, but it can be the most frustrating way because it takes so bloody long. Whereas it can feel nice. Oh, I'm going to go and appoint this external CEO, quick, done, take the pain. And that is hard. But yeah, Tech One is a great example. Even if Jobs had stayed with Apple the first time around, he would have killed it. It needed to have the suit retailored. Now, if Scully had stayed, and then the subsequent people who are only really interested in systems and process and controls and rhythms and whatever, they would have killed it. Jobs then came back and was able to overlay his entrepreneurialism into this newly systemized beast. The best way to do it is to try and keep both energies, is to try and have rails to run on where you can still have entrepreneurial flair and passion and whatever else, but there's a parallel rail building systems, process, controls, repeatability, authorities, doing it in parallel. But that doesn't just organically happen by itself. It must have intent. It must have a tried and true process. And if you get it right, as Adrian has showed from Tech One, you get the dividends.
Two other points on Adrian. That comment you made, Don, he takes a long-term view. Like, we know this about Adrian. He's looking 10, 20 years out, the way he thinks, and very patient with that, setting up that systemic approach. But it's not without him then feeling all the angst of not necessarily agreeing with what they're doing. And just some of the combos he's had with us, Don. But he doesn't let that emotion override the process.
Great point. There's a level of maturity of accepting that the baby's growing up and lets them do those things without jumping in and carrying on like a pork chop that so many founders do. Ash?
I was just going to ask if founders are thinking about, that long-term plan of who's going to take the ship over, what's the kind of timeline and transparency that you've seen work, like in terms of, are you starting to have those conversations 5 years out, 2 years out, 3 years out, and how long are you kind of, training's not the right word, but I guess it's refining that person's skill set to take over that role, and how transparent are you being with them of what you're trying to do throughout that process?
If you have a tried methodology and someone trusted to come in, you can do a fairly hard and fast approach to this if everybody's bought in. The less everybody's bought in, the longer things are going to take. Now, in an ideal situation, if a founder had got to a point to say, you know what, I'm not sure I want to be in this position or in this role, or I've got other desires or whatever it might be, 2 years minimum, because it's when we say 2 years, it sort of sounds long, but it's like how many budget cycles and how many strategy cycles and how many organizational restructures. And it's actually a very short number of those, even though it sounds like a long number of days, because you've still got to run the business day to day. So my suggestion is never less than 2 years, 3 years. But it's not 3 years, it's 3 budget cycles, 3 strategies, 3 restructures, a handful of quarterly performance reviews, practicing, setting up the decision making and whatever else. That's really what the driving factor is. But if you've got someone that you trust that can come in and help and has a methodology, if one of our portfolio tomorrow said, I'm out, help me, or the business is going to zero, I reckon within a few months, if everybody followed, we would have a situation where we felt we were reasonably in control, because the majority of staff don't need to be told what to do. The majority of senior people know all their problems. You don't need a bloody consultant to come in and tell you what actually needs to be done inside the business. What you do need sometimes is some rails to run on, is a methodology to align to a strategy methodology that automatically flows into structure, or a structure review process that automatically highlights where your strategy has problems. If you have those tools at your disposal, things can move very, very quickly.
I think with an investor lens on too, Don, like we had one of our portcos come to us and, mention he was looking to get out of the business, and how should he hand over? What should that look like? And that be a conversation we had with him. Like, that's driven by our perspective as an investor. And so I think there's some good lessons here for investors too, that might be thinking about replacing a CEO or replacing a founder and managing that as well.
Yeah, that's really true. That conversation gave way to a number of sessions, and I look forward to having them on a podcast where they can, in hindsight, in their own words, explain what we did or didn't do. All feedback is welcome. A company that currently is not having any liquidity problems nor leadership problems is Eucalyptus. And the amount of ecosystem news and excitement about a liquidity event of this size and scale in an environment where liquidity has been very hard to come by is obviously incredibly exciting. And so an article in Capital Brief says everything's coming up Eucalyptus. If you're outside the startup ecosystem looking in, you'd be forgiven for wondering why a single acquisition is commanding such airtime. Trade sales happening every day after all, but this one's different. This is what venture capital is supposed to do: back people who built things and make sure the people who believed in them got paid. Several hundred employees are about to share in more than 300 million. Blackbird is set up to return more than 2x its entire 2018 fund from this single bet. And the Australian ecosystem, which has spent the better part of 3 years in a collective crouch, finally has its moments. None of it happened because Eucalyptus None of this happened because of Eucalyptus House of Brands play or because of its clever demographic segmentation, not even because of its pilot pitch. It happened because co-founder and CEO Tim Doyle saw early what GLP-1 drugs like Ozempic were going to become, long before anyone in Australia was paying attention. He boldly made the call and then had the discipline to keep the business tightly focused on that opportunity. What a cracker, hey?
Oh yeah, I was just gonna say I'm a huge fan of Tim, and like this has been incredible for the ecosystem. It was even for me, and like we haven't chatted internally, but it's just a reminder of venture as an asset class, and like achieving these asymmetric results and outlier returns aren't possible unless you're playing in this space. And for it to actually turn into DPI, it's just like a good reminder of like why we're doing this and like why we spent the last 5 years trying to get this fund off the ground.
Yeah, absolutely. It's a big figure, but it's important to note that the first 240 million US is paid up front, which is 375 million, which is big money in anybody's vocabulary. But the rest of it, the 720 million US, and then the final earnout, is actually paid every 3 months via the issue of stock. Now, a lot of the reporting has concentrated on the fact that the clause deals with the fact that if the stock price drops, they have to issue more shares. But there's a couple of things that I've started reading a few bits and pieces, and I don't want to get into prediction territory, but this is the kind of deal that gets done when everything is looking millhouse. But there are some things in here that can turn pretty interesting. The 720 million US paid out every 3 months in shares. So if the shares drop, now keep in mind, the shares have dropped from, I think it's like $70 down to, let's have a look here. The shares hit a high of $64 and they're now at $15.80. So it's very interesting that this company that's had a big share price depreciation is using a lot of its stock for that. Its current market cap is like 3.6 billion and the total value of this acquisition is like 1.15 US billion. So I mean, this is close to 30% of the market cap of this company, and that's a big percentage in anybody's book. Now, doing a little bit of digging, in May 2025, him and hers, at the peak of valuations, right? At the peak of everything's wonderful, they set out to raise what looked at the time to be a few $100 million in a con note. They ended up raising $1 billion. Now, what's interesting is the terms. It matures in 2030, so there's a long way to go. There's 0% interest on the con note, and at the discretion of his and hers, they can settle by paying either cash or shares in its Class A common stock, or a combination of both. Then it then lists out what the conversion rates are. What seems to be occurring is the short interest in this stock is like up and down all over the place, but at some points it's like 40%. 40% of its stocks are sold short. And I think, and there's been some commentary on it, but one, Novo Nordisk is currently suing it for big dollars for patent concerns. Plus, one of the ways for those note holders to hedge out is to actually short the stock. So as the stock falls, the note holders actually have an incentive to hedge their position. Now, what's interesting is these notes trade as well, and they're trading at 68, 69% of face value. So the note holders, and given that this is secure debt, essentially, the note holders are not even putting face value on this bad boy. And so let's say that his and hers continue to have problems, and let's say that Novo Nordisk was to win, and you've got this contract over this next period of time where you have to keep issuing shares. You can see a potential, if something happens in the underlying business, every 3 months contractually, they issue shares, the share price keeps falling, they're going to issue more and more shares, which means more and more dilution, which means more and more propensity to short, more and more propensity to exit because shareholders are just getting diluted. I'm not saying it will happen, but these are the kinds of tricky financial things that in hindsight look like, how did we agree to that? And at the time look like a really clever thing. I'm just throwing out there that this is not the reports of a $1.6 billion exit, and more recent reports are talking about how it's broken down. Only a small part of it's cash in the bank.
This touches on our conversation I was having with a local investor a couple of weeks back who had invested in a company that exited, and they took some cash, they rolled the rest as scrip in the acquirer, because at the time its growth rates and all its metrics and phenomenal this and phenomenal that. I think it's now 5-6 years later, and that's looking like it's going to go to zero. And I think just chatting through that as well, the number of other investors that they knew in a similar boat that had a liquidity opportunity rolled up, took some scrip, and now it's very unlikely they're going to see anything from it.
And again, listeners of the podcast will know that we're just generalists, and on some of these things, I certainly don't know what I'm talking about. But in the documentation, it talks about that as soon as the SEC allows each share tranche to be sold, they can sell them. And so that's sort of trying to underline, there's going to be liquidity. But if you're in a pickle and you're an existing shareholder or a short seller, and you know that a whole bunch of shares are about to be issued, and you know that the receivers of those shares want cash, if it gets to a point where the amounts that they're issuing start to really compete with the market cap, then you'll find a whole lot more shorts, and a whole lot of people are going to make bets that X days from now it's going to be lower, because when they issue these shares, these people have an incentive to dump them straight away because they just want the cash. And then suddenly you end up in these reflexive loops. And so hope it doesn't happen, because the Australian ecosystem absolutely needs this liquidity event. It needs the full $1.6 billion to recycle. And I'm not trying to be a dick. I'm just pointing out that there's a few things not highlighted in the reporting.
It does make me think about unintended consequences, like things that are decided and put in place in good times when there's an abundance of capital that can come back to bite you. Hopefully it doesn't bite you, but can cause problems later unintended.
But what was happening inside the business that this deal needed to be done with a company that's being sued by how many $1 billion market cap is Novo Nordisk? So it's sort of like, my acquirer isn't exactly all that healthy, but I'm going to go and do a deal where a fraction of it's paid up front. Like I pose these questions. But let's get back to the main good news. An awesome founder was backed by venture capital and went out hard and built an epic business. And even if they only get the 375 million, which they'll get more of, don't anchor on that stupid comment. It's such a fucking inspirational and great story.
Yeah, 100%.
Now, Rayn Ong, also known as Ryan Ong or Ryan Wong sometimes, he gave an absolute masterclass on LinkedIn because he was one of the first angels in this. Rayn has to be, can we give him the title of the greatest angel investor in Australia?
Can we give him the greatest angel investor of all time? I mean, we can just give any title we want, can't we?
But tell me a deal he's missed. He's just everywhere. But he put a post up. Eucalyptus is being sold for $1.6 billion, making it one of the biggest VC-backed liquidity events. What can Rayn add to the story? The story is a bit long, so prepare some slides for you. Spoiler alert, it has everything you want. Swag, whiskey, balcony, and ebook. Read the slides first and then come back. So let's do that. Let's read the slides first. I'm in the health hub at the moment. I don't know if you heard that, but that's the hyperbaric chamber starting up. So I apologize. I should actually do an episode from the hyperbaric chamber. Anyway, it says, so Tim Doyle in 2019 posted on Twitter, and he's got a screenshot of the Twitter post. Does anybody know or can connect me with a GP who does not immediately spit venom at the idea of telemedicine that might be willing to chat to me about it? Rayn then sent Tim a DM, and he's got a copy of the DM that says, I emailed you the telemedicine reason. Then Tim sent Rayn his pitch deck. And the message from Rayn says, peptide co-slide, text repeated. So he gave some feedback on the slide and then said, can I invest 25,000? So Tim emailed him at 10:38 p.m. Rayn replied at 10:51 p.m. Rayn, and then Tim Doyle then posted, Rayn is the rare idea of an angel investor. He makes decisions quickly, wires the next day, and signs all of his docs on time. Are you listening, LPs? On top of that, Jack can see the irony of that conversation, given who on the call is the worst offender. On top of that, he never asked for a discount or jobs for his relatives. When he does offer introductions or feedback, they're usually helpful, simple to act on. Rayn should be one of your first stops. Rayn then shows his Eucalyptus swag that he got, and then a picture of it being sold for $1.6 billion. And that just has so many parts to it that I think everybody can learn of being out there, tracking different sources, moving fast, acting with conviction, being helpful.
How good is Rayn? I love this post. I love so much about it. But the comments back from the founder, I think just are an indictment on VC and angels in general. Like, move fast, which should be fairly standard. Do the docs, which should be fairly standard. Don't ask for jobs for like the self-interest in our space. But full credit to Rayn, a bloody legend. And his posts are always informative and educational while also taking the piss.
Yes. I want to talk to his manager about a few things. It was Rayn while we were waiting for a South Start event, wasn't it? When he said Blackbird's new pitch is same team, same strategy, wire money.
Yeah, it was like same team, same strategy, new fund or something like that.
After that, there was an article in Capital Brief by Bronwyn Clune that says, small is beautiful. Could Archangel's $40 million raise signal smaller funds are back? Melbourne's Archangel Ventures is raising its second fund, targeting $40 million to back Australian founders at pre-seed and seed. And managing partner Ben Armstrong says the firm has already locked in half of its target from existing investors. And I'm pretty sure I saw a post by Rayn where he's launching a new online course of how I raised half a fund in 3 days. I think that was the post, wasn't it?
Yeah. But like for me, yeah, our industry rewards fun, right? Like funds under management, size of the fund, all these things. You look at Rayn's check back in that previous one, 25K, but the ROI and getting liquidity. So liquidity and the return of capital speaks for itself in a market where we are struggling to get liquidity. And so I think this just demonstrates funds that, or investors that can generate returns and can return capital are winning. They're still able to raise capital.
I think one of his posts, did he say he got 200 times back in his investment?
Yeah, I kind of remember it being actually higher. I'll see if I can find it.
203.75.
And the 0.75 is required.
Definitely.
Jack,
sure.
Ash, give me something.
Everyone should go and read the comments in this LinkedIn post. They're high quality, good value, and just follow him. I love his content. I always get a giggle.
I got nothing to add on.
What's the lesson for founders?
Message, Rayn.
Something like that. All right, because we got limited time. Starting with Ash, what's your theme of the week?
Oh, building faster is needed, and yeah, just head down building anything I can, everything I can, and not being afraid to throw out what you built yesterday and start again if you found a better process. I think sometimes you get attached to it emotionally, where we're in a world where the tech is literally changing every 5 minutes. And if you're not continuing to evolve your processes, I think Jack called me 2 weeks ago and he was like, Ash, like, so what are you using? What tools, what workflow, how are you using it? And if he called me today, that would be completely different. And so I think I'm just like exhausted, yet totally and utterly excited about that, where it's just getting better and better every day, exhausting to keep on top of. Overnight, there was like 3 new things that got dropped, and in the Slack channel this morning, have a look at this. How are we going to implement? What are we doing here? How does this then flow into what we're building at Tribe? And how do we use that insight to then make that process more efficient? It's just this constant rework, but it's exciting. So I don't know what that overarching theme is, Don, but that's
I really like it. No, but I think that core of the sunk cost fallacy for humans is huge. I put all this time, all this effort, all this money, and I need to protect it. And that is becoming more and more redundant. And I see it with founders, I see it with investors, I see it sometimes with myself, where actually you've got to turn around and say, the world has changed. Today is a new day. What do I need to do? And so I think that's really good advice, because a couple of founders that I've been talking to recently, it's like, get with the program, man. You're living in the past.
Yeah, and don't just bolt this stuff on. Like you have to redesign process to have AI transformation. You can't just bolt it on the side and be like, oh yeah, we're AI native now. If that's where you want to put in your pitch deck, great, but your business won't be here in 6 months. Start having the hard conversations with yourself and start tinkering and building, and you'll be amazed at what you can do.
That's a good one, Ash. And that point about the exhaustion at the rate of change, and it is hard, but you just have to do it anyway. You have to. Yeah.
Jack.
I think, theme's got to be Eucalyptus. But the theme for us as investors is just a reminder that venture is unmatched when it goes well. I know we already spoke about that, but I think it's just a good reminder that why we're doing this.
No, 100%.
Venture is unmatched when it goes well. That also belongs on a t-shirt, Jack. I think for me, this week is chosen versus unchosen discomfort. I just think, back to what I said earlier, simple but difficult. There are things that, like stepping out of your business and taking the time to do that, and to your word, Don, from Adiz, is like that integration, that time to actually work on the business, not just in it. That does come at a cost, but you have to choose to do that and step into that discomfort of, I liked your line last week, Ash, like the answer may hurt, but chosen versus unchosen discomfort, you're going to have discomfort either way. There are going to be problems that require your attention either way. How much are you choosing what those problems are versus them happening to you? That's my theme of the week.
Mine's a little bit linked to that, I think, Aaron. Mine is actually this little meme for listeners at home. It's that meme where the bloke's on the bike holding the stick. He then puts the stick through the front wheels and falls off, and then he blames somebody else for it. And it's just been some situations where it's just funny how there are so many situations, and I'm not immune to this, where it was us who put the fucking stick in the spokes and then go and blame somebody else or something else, and an inability to take accountability for at least one's part in a situation. And to me, as this world of rapid change continues to occur, I think there is going to be a bifurcation at the performance level of the founders and investors who, if they have stuck their stick in the spokes, can quickly see it and go, fuck, that wasn't clever, I'll learn for next time, versus the people that just constantly keep doing it. And
I'm feeling that one this week. That's so bloody true.
Don't ride around with sticks, because then you reduce your propensity to do that. Let's get to shards, because whilst we got limited time, we don't want to disappoint Ash. So this is interesting, given we're going to San Fran. We fly out on Sunday, some earlier than others. This is a chart that shows Boston, Miami, Chicago, San Diego, Seattle, DC, New York, Los Angeles, Denver, Atlanta, and San Fran of VC-backed company formations since 2022. And San Fran is the only one that's up, and it's up 24%. And everyone else is down like 23%, 48%, 47%. So I know there was some talk a few years ago of San Fran's dead, but it is hoovering up. And if you are, especially in AI, you've got to be in San Fran, which is why we are going to San Fran. This is a interesting chart of effectively the NASDAQ versus the SPX equal weight. And so it just shows how a few names have brought back performance. And like Atlassian is down 70 something percent now. A lot of people have always called Atlassian's comp system a bit of a Ponzi, because so much of it was stock-based stock that sort of lived outside of the normal P&L. But when your stock's down 70%, there's a lot of people not getting paid. And there's people like Atlassian and others that are bringing back those broader indices. But despite companies like Atlassian and others really having a hard time, there's still a few companies really holding this thing up. And this is a chart of the market cap of the largest stock relative to the 75th percentile stock. And then it's in the weight of top 10 stocks. I would probably have to read that 5 times to actually understand it. But for listeners at home, it's a cool chart, because what it shows is the largest stock, and then a weight of the top 10 stocks, and then plots them in terms of a percentage. And we have now just tipped over Great Depression. Sorry, not the Great Depression itself. Obviously, the years just before the Great Depression. And then obviously we're well above the Nifty 50. We're well above the dot-com bubble. We're well above the GFC. And we're well above the COVID pandemic. Now, I believe we live in an exponential world and we've got to be careful with linear charts. And it would make sense to me with AI and a whole lot of other things that we're always going to make new highs. But when you make a new high, there does tend to be an environment where things have to reset and the lows can be rather brutal. And one of the canaries in the coal mine that I think we've really got to keep an eye out is private credit. Like, it is starting to really get into trouble. And this is a chart of Blue Owl Capital, KKR and Co., Apollo, Blackstone, TPG. And some of these are down 40 odd % in terms of share prices being rebased from a 100 base. But I think we're only just starting to see the signs of some of these private credit funds having to stop redemptions because of shitty credit. And often something happens in the bowels of the financial system that triggers everything. So it'll be interesting to see what happens there.
On that one, Don, I think a lot of LPs are exposed to private credit. So I think this has significant consequences for venture as well.
But we got a lot of rejection in the last couple of years because, I'm in private credit and it's giving me 16, 18%. So it's not giving you those returns because it's going to be old beer and skittles. So it's going to be interesting to see. This is Berkshire Hathaway's cash reserves, and we still achieving a venture J-curve here. We're about to hit $400 billion in cash. It's not vertical, but I'm not sure it can be more vertical. Then it was Valentine's Day last week, and I thought this was funny from the US Army. It doesn't take a mathematician to figure out a 10 plus a 5 equals a honey trap. Report suspicion. Are you a spy? Because you're too cute to be talking to me, says the picture. That was quite aggressive from the US Army, trying to warn the less attractive troops that if you've got somebody very attractive showing interest in you, they could be a spy.
US Army Counterintelligence Unit. I've got to report Mara and them because she's definitely a spy.
I'll leave that there. Again, just because it's charts and it's Valentine's Day and these things are all linked, don't ask me, Ash, how this got into my algorithm or why it's there. But this is a chart going back, looking at 1989 to 1993 is one cohort, and then 2018 to 2024 is another cohort. And it's a survey of the share of having sex at least once a month for the last year. Now, for the two cohorts, what it's showing is that's falling. So for the married cohort, that sort of naturally dips down, although I guess that's a much higher percentage than I was expecting in those later cohorts. And then the not married, that one truly falls off. And I assume that is the advent of social media and other distractionary things taking people away. But that doesn't bode well for humanity.
Don't get divorced.
I didn't hear that, Aaron. The hyperbaric. Say that again.
I said, I think there's something in there about not getting divorced. Stay married.
There you go. And then finally, I think I'm going to have to cut that. I don't think you guys are going to let me leave this in, are you? Am I allowed to leave that in because of the other things, or has that got to go?
I'm detecting a theme of the week here, Don.
Ash, you're the adult in the room. Can that stay, or does it have to be deleted?
I don't think it adds any value. I think it should be deleted.
Oh, that's different. That's different. The filter is not adding value here.
The filter is, I think it should be cut, but I was trying to say it politely.
All right. I'll see what mood I'm in during the edit. So what are we looking forward to? Ash, you want to kick us off?
I'm going to the Fringe tonight with Tim. We're having a date night, but it looks like it might pour. So let's hope it doesn't rain. He is having to have Friday, Saturdays off. So we're trying to do a Thursday night something so he has some feeling of a weekend.
Yeah, nice.
We'll see. I'm jealous that you guys are going off to the US.
As long as the snow stops falling in New York.
I think this is where I shared. One time with Catalyst, we had a mission to the US in March, and there was a snowstorm came through Denver, and they got stuck there for, I think it was like a week and a half. They couldn't get out.
Jack?
Yeah, I'm obviously looking forward to the US. Need to go get some warm stuff, so get that sorted.
I'm looking forward to the US taking off Saturday. Jack, I'll be just after you, but when I land, let's grab a beer and settle in.
All right, guys, I got to jump. The phone is ringing.
And what are you looking forward to, Tom?
I'm looking forward to going to the US. I'm looking forward to Jimmy Carr on Saturday night and then jumping on the plane Sunday morning.
Jimmy Carr will be
Good
sensational.
stuff. And we'll see you guys when you're back.
All right. See you then.
See you guys.